Hi, everybody. Welcome to ACC4620 Auditing and Assurance 2. We're going over Chapter 3 readings, and this is Chapter 7, Part 2, which is going over the first part of the chapter on materiality. So let's talk about what materiality and above all, what misstatements are. Because we throw that term around a lot, and sometimes we get a little confused. So a misstatement is any error or irregularity in the financial transactions, the account balances, the disclosures, whatever, that can lead to issues within the financial statement presentation. Now, there's a difference. We talk about errors and irregularities or irregularities. So an error is just that. It's an unintentional mistake. We make mistakes all the time in accounting. If you are processing hundreds of credit card transactions every day, or sales, or accounts payable, or posting accounts receipts, you are likely to create an error. That's okay. We're all human. Our eyes all get buggy after a while. So they're just unintentional mistakes, and they could be due to maybe you have a training issue. You have a new person in the job, and so as a manager or a supervisor, be aware that new people are going to make mistakes. So you're going to have to scrutinize their work much more closely. You might have a lack of review of work. Maybe you are not reviewing the work close enough for people, which is should be part of your duties, is to oversee, run edit reports, review transaction entries to make sure that things are posted correctly. Finally, you might be able to identify errors through poorly developed processes and procedures. When I was writing my dissertation, I was looking at the internal controls over the likelihood of cash fraud, or the awareness of cash fraud in nonprofit organizations. One thing that I used as my support in that dissertation were interviewing people about the processes, the step-by-step guides that they were using to post cash receipts. How did they get the cash over the counter? What did they do with the cash? How did they record the cash? Who reviewed those cash reports, etc.? And what I found in some cases, not in all cases, but in some cases, the staff who were doing the work were responsible to write their own procedures. And there was very little oversight by the board or by management as to if they were writing their procedures up correctly. So that could lead to errors. Now, on the flip side, irregularities are intentional, and they may alert us to potential areas of fraud. And irregularities are those types of entries or transactions that don't conform to the normal practices and rules of accounting. For example, if you have entries where you are doing the prepaid expenses and you're posting those into a different expense category intentionally, that could lead to a potential of fraud. If you are not conforming to generally accepted accounting procedures, your processes do not follow GAAP. You may have an intentional or deliberate intent to deceive or defraud. There may be omissions or disclosure issues. For example, we don't disclose to our shareholders that we retroactively made some corrections to our financial statements, or that we changed our accounting principles. Maybe we went from FIFO to weighted average inventory valuation, but we didn't disclose it to our shareholders. That could lead us to a potential act of deceit or defraud. So errors are just regular things that happen, irregularities call into mind whether or not there is intention behind the actions. So if we understand that misstatements could be irregularities into a system, then as an auditor, we must develop levels of materiality in which we are going to perform our substantive tests and our audits. We have to set up materiality because there is no such thing as a 100% audit. So you're going to have to make some judgment as to what is important that needs to be corrected and what may be an error that exists in the system, but it doesn't rise to that level where it would skew the fairness of the financial reports. So we think of this as materiality. It's probably the cornerstone of audits because it is a concept that we consider both individually and in totality of our audit. Materiality is used in planning and evidence evaluation. First, we have to determine the nature and the extent of those risk procedures. Second, we have to identify and assess risk of material misstatement. And three, we have to determine the test of controls and the substantive test used to confirm or reject our assertions. We have what we call overall materiality as a type of audit materiality. And we're going to get into this in the next slide. But part of that overall materiality also includes performance materiality and posting materiality. So there's components within overall materiality that we have to be aware of. So in overall materiality, we have to look at planning materiality with the assumption that whether or not the financial statements are materially correct. So that's that totality. When we're looking at performance materiality, we're looking at how much tolerance of error we're willing to accept before it becomes material. So we have to develop some audit procedures that hone in on specific accounts or specific locations if you are a diverse company. So we have to look at those significant accounts that are significant to our company and our industry. And we say, what is going to be our tolerance for error within the totality of that materiality of the financial statements? And finally, we look at posting materiality, or what we also call specific materiality. And we review that throughout the audit and identify, and we usually keep a log of all of the little errors that we see. And at the end of our audit, we add up all those little errors to see if in postings that the totality of those errors in postings could lead to a material issue in the overall concept of the financial statement results. When we think of the concept of materiality, it's really dependent on the company, the past history of the company, what's been going on with the company, have there been changes within the company, as well as if there's any volatility in the industry, and if there are internal or external issues that could be affecting the company. And we'll take a look at those also in this presentation. Now, remember, in my first Chapter 7, Part 1 lecture, we talked about the PCAOB. And I showed you how to dive into the PCAOB, especially as it conforms to Auditing Standard 2110 on materiality and risk assessment. So you might want to go back and review that, because this part now starts to incorporate those auditing standards. So we have certain procedures we have to follow. And most importantly, we need to document them. So here are the procedures, and I've given you the subsections of 2110, of AS 2110, that you can go back and look at. So first, you have to obtain an understanding of the company and its environment. What is this company? What does it do? What is the environment? And we talk about the environment as part of not geographical environment, global environment, the environment, the control issues, what's going on within the environment today that could be helping us to understand the company a bit more. We also want to obtain an understanding of that company's internal controls over financial reporting. That's part of one of our tenets in the PCAOB cube. So what are the internal controls that management asserts? And do we understand that? Then we want to consider the information of past audits and other engagements performed for the company. If you are a first-time auditor of this company, you will have a lot of in-depth questioning and interviewing of the company at the beginning of the audit so that you have a firm understanding. You might want to look up past audits if they're publicly traded, or if there's a way to gain information from the website, maybe their annual shareholders report, their SEC 10K reports, so that you understand what's been going on in the past, as well as if there have been other engagements performed in the company. If you have been the auditor for more than 1 year, look at your prior working papers. They will help guide you as to issues that may have come up in past audits that you need to consider in this audit. You need to perform analytical procedures, and we'll talk about those later. You're going to talk amongst your engagement team, your audit engagement team, and you're going to talk to the members, and we call it brainstorming, and we'll get into brainstorming regarding the risks of material misstatement based on their understanding of the company. So you may have several members interviewing different members of the organization, and then you all come back together and say, well, what did we hear? What did we see? What did we observe as we perhaps toured the facility? Did we see a nice, orderly working office? Do we see assets secured? Or does it look like chaos is reigning? That discussion will help you come together to form the risk of material misstatement. You're also going to perform formal inquiries of the audit committee, finance committee, whatever the board of directors oversight is, key management personnel, and others within the company about the risks of material misstatement. You might talk to the production manager or the VP of production about some issues that could lead you to a risk of material misstatement. Maybe they're having issues with third-party providers or supply chain issues, which could cause potential issues to occur. Perhaps you talk to the legal department and you find out through reviewing the board of directors minutes that there have been a number of litigations being brought forward to that company. Maybe that company is private and they're thinking about going public. So those are the things we want to talk to management about in order to really understand what's going on in this company. Now, we have to remember that this is based on auditors' professional judgment. That's why we want everybody involved. We're going to want our senior staff, senior audit staff involved, as well as our junior audit staff involved, so that we can get a really sound, full perspective of what's going on in that company. We will set materiality at the beginning of the audit, and we will set it for not only the overall financial statements, but probably those significant account balances that we have, significant locations, perhaps where the inventory is located. And then we proceed with our audit. However, if something occurs and we have to change our materiality for whatever reason, we may discover something which increases or decreases our materiality threshold, then we need to reassess and redocument that change. Now, we have lots of benchmarks out there that we can use for materiality. The text gives us this, and this is pretty good, but again, it's going to be client, auditor, and industry specific. So we have some common benchmarks. We look at net income as a benchmark. Has net income changed? Hopefully it has for the better. Now, materiality judgments could be anywhere between less than 5% or greater than 10%. So if there is an error or an irregularity that causes the net income to be, if we made a correction to that net income and it exceeds 10%, that's going to be a material change. If it is 3%, so we go through all of our work testing net income and we find out that there's a 3% change. It's not material, but we may go ahead and ask the company to make the change. It's up to them, but we would want to bring it up to their attention and let them know that there's something going on that may, in the future, cause us to question net income. Now we see total assets and total sales have a much smaller materiality threshold. For example, if total assets are incorrect based on our audit processes by 3%, that might mean we have a materiality issue, that the assets of the corporation are misleading to the users of the financial statement. Now, 3% may not seem like much if you're a company with, $10 million of assets, but it could be material if it's 100 million in assets. So when we're considering this concept of materiality, we have to keep some things in mind. First, we have to focus our attention on those items that may be significant within that industry. For example, the airline industry, we may not have a lot of accounts receivable, but we may have a lot of fixed assets. So we have to look at that. What's going on with that industry? We have to look at the nature of the client, the nature of the company, and the nature of the industry. What's been going on in the industry? Have we had airline strikes, which has decreased revenue for airlines? And if airlines have to meet a certain, if management states we have to meet a certain threshold of revenue, there may be something going on in that revenue we want to take a closer look at, because we have a volatile industry going through a very difficult time. And if there's pay based on results or compensation based on results, we may want to take a close look at that and make sure that the revenue is actually what the revenue should be. We want to look at the size of the client. In this case, size does matter. And when size matters, we have to look at the relevance of that size. A $10 million organization is going to have much different thresholds than a $100 million organization. So we can't apply the same numbers in each instance. We may have to look at the manner of how the client is receiving financing. Are they going through debt financing, which may create some debt covenants in their liabilities, which may pose a risk? Or are they heavily equity financed? Are they selling off ownership of their company, which may put them in danger of some other company or entity getting control of them? We have to look at the volatility of the benchmark account that we're looking at. In a nonprofit organization, cash is probably going to be extremely volatile because there is a huge likelihood that theft may occur. In a company where cash is not king, we may be looking at accounts receivable or accounts payable as more volatile. And finally, how intense is this entity being reviewed by outside analysts? So go out and look at some outside, go look at Morningstar, go look at Merrill Lynch, go look at these investment companies and see what are they talking about regarding the company. Do they have some concerns going on? Maybe there was a change in senior management that is causing some upheaval in the company. And there's some questions as to whether or not the company is as stable as maybe they try to assure you. So go out and look at third parties, see what they're saying. So in summary of this short area of materiality, I want you to understand that there's an inverse relationship. So when materiality levels are high, it creates a lower audit risk because we have more comfort by setting a very large materiality level that they're not going to have that many errors. But if we feel that there are a lot of errors or there's a lot of unsteadiness in that company and materiality level is low, then there's going to be a higher audit risk. So the higher the materiality level, the greater confidence that there is not a misstatement going on, and thus a lower audit level risk. Please reach out to me if you have any questions on this, and I will see you in the classroom.